Let me just jump right to it. So welcome everyone. Thank you for joining us early this morning. And I don't plan on having any fluff. So right into the numbers, right into the spreadsheet. This might be your first panel, so I apologize about that. And please, let's make this interactive. So hopefully you can put in some questions in the chat box or in the Q&A, and we can steer the conversation that way. I want this to be an interactive discussion. So let's jump right in. We're talking today about how to structure deals, and this is more so focused on the sponsor structure, the GP-LP structure. But if we get comments in the chat box, we can also discuss more specifically the capital structure with debt, mezz or pref, and different senior subordinate structures and equity and things like that. So yeah. So first, let's lay the groundwork and let's just discuss the most typical joint venture GP-LP structure, especially in the context of a syndication, whereby you have many LPs rather than one LP, right? One large investor with investing with you as a sponsor will look very different than many investors investing with a sponsor. So we'll look at the many approach first. So typically, an investment will have an acquisition fee or any fee that will be paid out of closing. And this is kind of a headliner. A lot of people know about this and look at the fee, and they want to make sure that it's market. And market today is typically anywhere from 1% to 2%. Asset management fee is paid out of operations based on effective gross income usually. There are other ways to structure it. So it's important to not just accept these numbers as I'm going through them, to not accept them at face value. A 1% asset management fee or 2% acquisition fee, those don't necessarily mean the same thing in all places. So for example, an acquisition fee is typically based on a purchase price. However, it could also be based on total capitalization. So including the construction budget and closing costs and all things like that. An acquisition fee also could be based on equity. So we're actually doing a deal where the acquisition fee is 3% of the equity raised, which actually ends up being about 1.2%. So there's just different ways you can structure it, and don't just accept the numbers. Oh, 1%, 2%, 3%. Really dig in and understand what do they mean and what are the net economics to me as an investor if you're sitting on that side of the table. So an asset management fee is most typically paid quarterly based on effective gross income. And then the next part of the typical structure is the preferred return. Today, preferred returns are anywhere from 6 to 10%, most commonly 8%. And the preferred return is either compounding or non-compounding. It most often will always accrue. So missed preferred return payments will accrue to the following period. However, compounding is more of a toss-up. In more institutional level deals and more sophisticated investors will certainly demand a compounding preferred return or even an IRR hurdle, which I will explain next. But quickly, if you're not familiar, preferred return is a waterfall structure in which the investors will receive the first, the cash flows up to a certain return amount. So in the 8% example, if investors cumulatively invested $1 million, the cash flows generated by the property, net of fees, so first the asset management fee would be paid out, debt service would be made, and all expenses are paid, then investors will be entitled to the first 8% or $80,000 on an annual basis. And then thereafter, a promote may or may not kick in. And a promote is whereby a sponsor is able to capture a disproportionate amount of the cash flows or profits of the venture. And this is most typically, like right now we're going through a typical deal, is most typically 70-30 or 80-20. You see it all across the board. It really just depends on the sponsor's relationship with his investors or her investors, track record, the deal itself. So if a deal is more of a heavy lift and more operationally intensive and requires more time and effort, then sponsors should be able to command a higher split for themselves on the promote because they're putting in more effort. However, if a sponsor is simply more so placing equity in a stable deal and they're going to set it and forget it, and it's going to, they're going to get a monthly report and, the deal's in a great class B plus area and it runs itself, then maybe the sponsor should only be getting a 20% or 15% promote. So it just varies. And as an investor, again, if you're sitting on that side of the table, it's all about understanding what is market, what is fair, and what are the numbers that I'm being told actually mean? Because you could be told, oh, it's an 8% preferred return, but you may not actually be getting what you think you are because, like I mentioned, it could be compounding or non-compounding. And if you're not familiar with how that works, simply if you're owed your preferred return in a given period and it's not paid, the shortfall will compound at the preferred return rate. So let's say the sponsor missed $100,000 that was due that quarter, that $100,000 will accrue to the next period at an 8% rate as well. So that is a nice protection mechanism for LPs, and which is why I strongly advocate for it, because we'll get into some structures that don't have a preferred return, which actually, if structured fairly, will generate a projected similar net economics to investors, however, with far less downside protection. If you stress test the deal, you don't have that preferred return that really sits there as an anchor for an investor's minimum return. Whereas in a no preferred return split, every dollar in reduction in profit, that's a reduction in your profit. So preferred return is a nice hedge and a little bit more defensive of a mechanism. I personally would rather invest in a deal that maybe projects a lower return but has a preferred return rather than a deal that projects a higher return and has no preferred. So next, let's talk about IRR hurdle. So preferred return and IRR hurdle are very similar. They could be the same number, 8%, but now it's a hurdle based on internal rate of return, which in order to hit an 8% IRR, for example, you would need to have a return of capital 100%. So if an investor invests 100,000, they would first need to see 100% of their money back, so the 100%, $100,000 back, and then an additional, roughly speaking, $8,000 per annum in order to meet that IRR hurdle. And again, IRR is a compounding calculation, an annually compounding calculation. So as you're going through the periods, if you miss a payment, that money will accrue and compound at the hurdle rate to the next period. So IRR hurdles are not common in syndications, but they are the standard for institutional private equity transactions. So if you are looking for a more sophisticated structure, or you're a sponsor and you are looking to pursue institutional type equity or private equity or even family office money, you will most likely have to familiarize yourself with and get used to the fact that you will likely be in an IRR hurdle scenario, which is a good or bad thing. Hang on, let me just check the stats. GM this model to share to participants. Great, I forgot. So if you go to lonestarcapgroup.com/newsletter and put in your email, an email will be sent to you and you can download this spreadsheet. And I apologize that I'm just sitting here on the same tab and I'm just blabbing at you, but I will get into the spreadsheet, but I'm just laying the groundwork. So back to the IRR hurdle. So institutional, and the tough thing for a sponsor is what this means is you really aren't going to make any money on the promote side until you sell. And that's simply because in order for your promote to kick in, you're going to have to return all of investor capital back first. Now, theoretically, that could happen through a refinance, but most likely it'll be via a sale. So again, as a sponsor, you're going to have to be comfortable with acquisition fee, asset management fee, and then all cash flows in an IRR hurdle scenario, all cash flows go to the investors. So as an investor, this is pretty amazing. And I understand why institutional investors writing big checks demand this, because they're going to see all the cash flows, and the sponsors promote a subordinate to an 8% IRR. So as an investor, I can feel pretty good that I'm going to get an 8 IRR, or else the sponsor will make no money. But as a sponsor, you really are motivated to sell. So if I'm an investor who wants to put my money out and not worry about it coming back to me, I have a far better chance of that actually happening in a preferred return scenario where the sponsor is promoting ongoing cash flow from operations, because they'll be potentially more content with owning the property because they are participating in the cash flows. Whereas in an IRR hurdle scenario, you pretty much can guarantee that the sponsor is got their eye constantly at the exit, because they're looking to monetize their promote. So if you're an investor who wants to churn their money and place it with sponsors that will hopefully provide a lift in value, sell and you get your money back, IRR hurdle would be the best way to go. Otherwise, you may want to consider some other interesting structures that we can discuss later. And then I'll briefly touch on tier 2 hurdle, which is where upon sale, if there might have been an 8% hurdle, but then above 18%, the profits are split 50-50. So pretty straightforward, pretty simple. The one nuance is, what is that 18% based on? Is it based on the project generating 18%, or is that 18% delivered to investors? And then once investors have actually received 18%, the 50-50 split begins. So that's actually a meaningful nuance, and kind of complicated. And you would really have to dig through the operating agreement to figure this out. Or you could simply ask the sponsor this question, and they'll tell you. And so I'll finally click into the model here, but you can see on the, where is this? So the hurdle type, it can be based on the project or the LP's return. So as we're creating subsequent tier hurdles, these hurdles could be project-based hurdles so that the project generates an 18% IRR, or it's an 18% hurdle to the investors. So that once the investors have received an 18% IRR, now the cash flows will be split in a different promote split. So that is a general overview of the typical structures, preferred return, IRR hurdle. Again, please utilize the chat box if I'm going too slow, moving too fast, you want me to cover something again. Yeah, so let's just run through a typical scenario. So what I've done here is I've done an example $10 million deal, 150 units. Your in-place rents are $800. You're going to raise them to $950. Everything is pretty, normal here. You've got regular per unit operating expenses. And in the end, your stabilized return on cost is a 7.5%, which is pretty strong because we're going to assume that this deal is in a market that cap rates today are trading at 6%. So you've actually, through your business plan, have created real value because you're able to create cash flows at a 7.5% yield on cost in a market that is valuing cash flows at 6%. So you've created some value for yourself. Okay, somebody has said, it is my understanding that sponsors are moving away from prefs. Is that your experience? I don't see where the underwriting model is on the website. Good questions. On the website, you have to press the subscribe button, and then it'll take you to the page to fill out and submit the form, and then you'll get an automatic email. So check your inbox and potentially your spam. So are sponsors moving away from prefs? So I would say mostly no. Again, there are certain groups of investors that it is more normal not to have a preferred return, and there are arguments as to why they do not. However, I have not seen a move away from prefs. But that if you are experiencing that, I would say it does somewhat make sense because yields have materially decreased, and hitting an 8% preferred return is very difficult and almost unrealistic if you're buying high quality assets in B class and above locations. Because simply if you are buying that quality of an asset, you are paying for it, and you're going to be buying at a 4.5 to 5.5 cap rate. And you can understand if you're buying at a 5% cap rate, call it 5.5% cap rate, and you're leveraging at 4 or 4.5%, there is not enough arbitrage there, positive leverage, to generate a cash yield, a levered cash yield of 8%, maybe on an interest only basis. But then of course interest only runs out, and now you're amortizing that 4% debt, which that creates a debt constant of almost 6%. So that's a tricky scenario. So I can understand why preferred returns are being moved away from in deals where cash flows are very light. But, and jumping to another topic, is on the flip side, I've actually seen a new wave of preferred equity structures or dual tranche syndication structures. I've written about this before. It's a very interesting topic and structure from both the GP and LP angle. And so what is preferred equity, and when to use it? So preferred equity is a structure that is a bit more hard and meaningful than the preferred return. So preferred equity, do not confuse that with preferred return. So preferred equity actually is a separate tranche in the capital structure that is senior to the common equity, but subordinate to senior debt. So this means that the preferred equity is due the first cash flows. So all cash flows after debt service that are available are due to the preferred equity up to the preferred equity's return rate. And that may be anywhere from 8 to 14%. But I've mostly been seeing 10% preferred equity deals. And this is really just a form of leverage. It's you can call it soft debt, similar to mezzanine financing. And preferred equity has many wrinkles, and it can have certain control rights. But you must understand, if you're investing as an LP in preferred equity with many other investors, you are likely to be a group of disparate individuals that have no real say in the deal. Whereas if you're an institutional investor that has the capability to take over a deal, being in a preferred equity position will potentially, if negotiated in the agreements, will allow you to remove the manager, take over, and step into the common equity shoes, and sometimes actually foreclose on the common equity and take over the whole deal's equity. So again, not all preferred equity is created equal, but that's another interesting way to squeeze a little leverage into a deal. But we'll talk about later whether that's actually a good thing for the GP or not. So let's go back to our example here. So we've got our value add deal. We're getting to a 7.5% return on cost, and let's jump to the waterfall. This is generating a 9.7% unlevered IRR for ourselves. So when you put in the debt, we're almost at a 20% IRR. And just running through the waterfall. So in this example here, we have it set as a preferred return hurdle, and the preferred return is compounding. So what you'll see here is, first we have our net levered cash flows after paying the fees. So this is the acquisition fee, asset management fees, all throughout the 5 years of the hold period. So these are the net cash flows after fees have been paid, and that's an 18% IRR. And now this is cash flows that are ready to be flown through the waterfall. So here they are. So as you can see, the preferred return is 8%. So we need to make sure that preferred return is paid. And you can see in year one, the distribution is a little below the preferred return. So actually the capital account increases because now your pref was $241,000, but now it's increased to $242,000 because of the shortfall. So it accrued and compounded to the next period. And you'll see how that occurs throughout the periods. And then upon sale, if you haven't paid that preferred return, if you're not current on your 8% preferred return upon sale, you'll have to use actually profits from sale to catch that pref up. And then once that pref is made whole on its 8% compounded return, which is really an IRR hurdle, then the promote will kick in. But you can see in our scenario, moving to the tier 2 of the waterfall, the sponsor is actually hitting the promote in year 2. So even though they had a shortfall, they caught it up, and there's actually cash flow remaining in the preferred return, and then they're actually collecting a promote out of cash flows. So important to understand the differences, because if we turn this preferred return hurdle to an IRR hurdle, that will not happen. All cash flows will simply go to investors, and the GP will just be waiting until the sale to receive their promote. So this is how a typical waterfall structure works. As you can see, at the sale, after the 8% preferred return is made, there's still $2 million of cash flow remaining to waterfall through. And you'll see that the promote is then paid at here in our example is a 70-30. So here's 30% of the cash flows after that 8% compounded return are made good, are given to the GP as a promote. So this is that example. And again, we can get into different structures where maybe up to the second tier is only 15%. And then this becomes 40. And then you'll see that in tier 3, we're receiving, there's just a little bit more IRR left, a little more juice left after 15. And so the sponsor gets 40% of what's remaining of this 111,000. So they get the 44%. So we'll play with this more. And I also want to bring to your attention the compensation analysis, because as sponsors, if you're listening to this as a sponsor, different structures are great, but you want to understand, what does this mean? So if a sponsor approaches you, if an investor approaches you, let's say a family office or a more sophisticated investor, and they propose a structure to you, which you've never experienced that, you're used to proposing structures to your investors, you want to be able to analyze it and compare it to your existing way that you're putting deals together and understand, okay, what are my economics, and really understand them. And so the way that I like to evaluate sponsor compensation is through a few ways. So number one, a net present value discount. So it's great if you're going to hit your promote 5 years down the road and make $1 million, but that's 5 years down the road and there's uncertainty. So we need to discount that value back to present using a discount rate. And I just slap on a 20% discount rate, which is pretty aggressive, but that's just the number that I've chosen. And then the other discount I use is a promote uncertainty discount. So fees are they're more certain. Acquisition fee is very certain, so there's no discount at that at all. Asset management fees in the future should just be discounted back at your discount rate for the MPV calculation. But a promote is a highly levered number, because if you think about it, we're already using leverage, and then you're using LP equity as leverage. And if a slight change in the returns happen, your promote will vary significantly. And we can even do this. Let's actually play with it. So you can see the promote here in this example is $603,000 in total in year 5. So this is that cell J74. And this is based on, as you can see, investors receiving a 15.3% IRR. Well, let's just tick down the returns ever so slightly and see what happens. So what I'm going to do is I'm going to say, let's say instead of selling at a 6.5 cap, we'll sell at a 7 cap. So we're selling at a lower price. So investors get a 12.6% IRR, which you could argue is materially lower than their 15.1 previously, but it's still a good return, and they're only losing so much. However, on the promote side, you can see the promote went from 602,000 down to 336,000. That is a massive change, huge difference. So, and I just did this now. I didn't practice this before. I was really hoping the number was massive because I didn't want to look foolish. So that is the leverage inherent in a promote. So we must discount that. And now I'm going to just jump to questions here. So what is unlevered IRR? Great question. So unlevered IRR is calculating the return of the investment on a no leverage basis. So if you were to buy the deal in all cash, finance your CapEx through cash, there's no leverage employed at all, that would be your return. And so typically a good unlevered return, just so that you have a basis of understanding, and this is again before fees, so no sponsor fees or anything, just purely unleveraged returns. A good unlevered return is anywhere from really 8 to 12%, depending on the deal. And if you think about it, if your business plan is to buy and hold forever, and you really want to bank on cash flow to earn your return, then you should actually see your unlevered IRR, the longer you hold, trend towards your cap rate. Because what is a cap rate? A cap rate is a measure of unlevered return, your NOI divided by purchase price, or your basis if you're going to include CapEx and renovation funds. And this is your unlevered cash flow, which is NOI. So cap rate, unlevered IRR, they should trend to the same number somewhat, unless you're creating a lot of value via buying low, selling high. That's where you're going to see the difference between cap rate, unlevered IRR. Again, Alejandro asks, where can I get the Excel sheet? Again, go to lonestarcapgroup.com, and you can scroll down on the homepage, click subscribe, and you will get an email with all these resources. I am not able to download the spreadsheet. Okay, I apologize. I wonder if I can just drop this in there. Okay, well, let's get back to that, please. So you should receive an email, and in the email it'll say underwriting model package, and you should be able to click on that underwriting model package, and it'll take you to a Dropbox link, and you can download the spreadsheet. Let's hopefully at least one of us on here can get that, please. If you've been successful, thank you very much. Okay, great. So back to the leverage of the promote. So you can see the crazy change in the promote here. And all we did was change the sale price from a 6.5 cap to a 7 cap, which is a big difference. But nonetheless, the investors only received a 2.5% change in their IRR net. But you as the sponsor almost halved your promote. So that's why we have to assess an uncertainty discount. Yeah, I apologize. Easy to miss. Thank you very much for catching that. So that's the way that I analyze sponsor compensation, is through the 20% discount rate and the promote uncertainty discount. And then in the end, when you sum your fee compensation and performance compensation, discount it to present and discount it for the uncertainty on the promote side, you'll end up with one number, right? And then I like to take that number and divide it by the amount of equity required to do the deal. And then this is your final number here, which in this case is 9.2%, which isn't bad, but it's not great. So this is an interesting number that I invite, if you're a sponsor, to keep track of on your deals, to see what the heck am I doing all this work for? Because some people have the conception that sponsors make a ton of money, but that is not necessarily always the case, because there's a lot of work involved. And so as a sponsor, it's important to understand, why am I doing this? How much am I getting? And what if things go wrong? So that uncertainty discount helps, because our underwriting does tend to be a bit more aggressive. And so you want to combat that with a more, with that discount. So let's jump back here. So we've discussed a little bit about preferred equity and how to measure your sponsor compensation. So let's just look at the chat real quick, and then I'll address, okay, what percentages on average do you see for acquisition fee and asset management fee? Okay, great question. So the average for acquisition fee is 1 to 2%. Again, this is more on the syndication retail equity side. If we're talking about institutional and more larger deals and private equity type of deals, sometimes they don't even want to pay an acquisition fee. So it gets rough out there. So 1 to 2% of purchase price, that's the most typical. And then asset management fee is 1 to 2%. And it's also, the asset management fee cannot be discussed without the property management fee, because especially if you're vertically integrated and you're the property management company running the deal as well, there needs to be an all-in number that makes sense to the investor. So, you might say, well, I'm only charging a 1% asset management fee, but your property management fee is 5%, right? So you're above market. So what is most typical is an all-in property management fee, all-in management fee, property management plus asset management of anywhere from 4 to 6%. Okay, we're getting some good questions jumping in here. I'll try to address them and then jump to the next. So can you talk about how you project your exit cap rate? Okay, great. So don't want to spend too much time on it because I do want to cover structure more so than underwriting principles here. But exit cap rate, basically, we're in the markets that we understand, and we look at many deals, different types of deals. We look at stabilized deals, which really you're buying yield and you're buying in-place cash flow, which is a much more cappable. You're able to put a cap on that transaction much more readily than a value add deal, because you may be buying a 4 cap, but you're going to bump rents $200, and in the end you'll be operating at an 8 cap. So harder to cap a value add deal, but we look at both deals. So what we do is we want to understand what are stabilized deals trading in the market, because when we sell a deal, we most likely intend to trade it as a stabilized asset, which may not be 100% in our favor, because at least in today's market, value add deals are in such high demand. You can take less risk, less execution risk in your renovation business plan, and sell for a higher price, because you'll sell to a value add investor who's banking on the promise that they can renovate, raise rents. So you may even in this market be better off selling a property that is unrenovated, marketed correctly with the upside of the renovation, and you didn't even take the risk of the renovations yourself, and the risk of pushing rents and turnover, handling evictions and things like that. So I digress. So the exit cap rate, we want to understand what are stabilized deals trading today. So let's say in the market that we're in, it's 6%. So if it's 6%, we want to be roughly 50 bips wide of that. So our exit cap rate will be 6.5% in a market where deals are trading at 6% on a stabilized basis. And I use those numbers because I'm dreaming, because in reality in our markets today, quality assets that are stabilized are trading closer to the 5 number rather than the 6. So what that means is I do not care at all what I'm buying for. Meaning if I'm buying a 4 cap, a 3 cap, I do not care, and that does not factor into my exit cap rate whatsoever. It is all about the market cap rates, not what I'm buying for. Because what if I'm buying a great deal, or what if I'm overpaying? If I'm overpaying in a market that's a 5 cap, but I overpaid and I ended up buying a 4 cap, should I realistically be allowed to exit in my model at a 4.5 cap? That doesn't make any sense. So got a couple more questions here. How do you project vacancy, rent growth, expenses? Okay, this is unfortunately outside the scope of this presentation. I've got to move along. But I love all these questions, and I would welcome the opportunity to answer them in another forum at a later time. So let's just jump into what structure should you use for your first deal. So as a sponsor, my advice for your first deal is to try not to stand out in any bad way. If anything, you should be looking to stand out in a good way, but we'll also discuss why that may work against you. So, and what I mean by this is you should not be creative in your first deal. A confused mind says no, and this is very true for investors. So you should be as close to market as possible and potentially even scaled back, because as a new sponsor, why should you make the same as seasoned sponsors that have been doing many deals, right? So you should take a beginner discount, a modest one maybe at most, but there should be something given towards that. So, but on the flip side, You don't want to give away the farm and tell investors, hey, that acquisition fee, don't worry about it. Asset management fee, well, I'll waive it if you're not hitting your promote. And my promote, I know it's normally 70-30, well, I'll do 80-20. Because at that point, you've put yourself in a very tight box. And if you are raising, or if you're raising capital on a contingent basis, meaning you don't have dedicated capital, which if it's your first deal, it's highly unlikely that you do, and you're in your capital raising process having a hard time, and you want to reach out to partners to help you raise the money, they'll look at your existing structure and say, hey, there's not enough meat on that GP bone for me to want to partner with you, raise the money, lend my brand name and reputation to the deal so that you can raise the equity and I'll help you raise the equity. But as someone coming into the deal, what are they going to get in return? The fees and the structure is already so slim that there's not enough. If you're forced in a situation to give away economics, you're giving away everything because you already gave away to your investors. So that's one thing to be aware of, and make sure that there's room to bring in partners to help you get a deal closed. And this may be maybe for all your deals. And it may not be just as a contingency, it may just be your protocol to want to bring in partners, and that way there's room on the GP side to give it away. A lot of investors may see deals where very high fees are being charged, and this is true, high fees are being charged, but they're being spread amongst a fairly large partnership. Likely in a syndicated transaction, there can be a handful of capital raisers that are partnering to bring equity to the deal, and they're receiving a share of the GP. So in the end, if you see a big wow acquisition fee of $500,000, that is unlikely going to just one person's pocket. There are many expenses to that, and it's not as rosy on the sponsor side of the table as you may think. The LP side is a wonderful place to be. So how to best assess sponsor compensation. So we went over that. I think that's a fascinating topic. I've written a little bit about it. I'm still learning myself. I'm trying to pay attention to, what are we projecting to make on this deal and why, and what levers can we pull to make more money on a net present value basis, because I'm very driven in an NPV fashion. Just because you have to think logically, and I do not consider dollars tomorrow equal to dollars today. So let me touch on unique structures and when should you use them. So I talked about your first deal and why you should use a very standard structure and maybe give a little bit of a discount rather than a 2% acquisition fee, maybe do 1. But then it'll make harder for partners to join with you because that acquisition fee is compressed in their eyes, and that's less that they see that they can command if they join you. So maybe it's best to reduce your promote. So in terms of unique structures, there's all sorts of interesting things, and we talked about no pref, and I touched on why I don't like the no pref, but to go over that again. So sometimes you'll see structures where rather than an asset management fee, they'll do away with the asset management fee, do away with the preferred return, and simply structure the cash flows at an 80-20 split straight away and throughout the whole investment, on cash flows, on profits upon sale, and it's only subordinate to a return of capital to investors upon sale. So this, in the end, is not, in terms of projected net economics, what are investors actually going to take home after this structure is fairly similar to an asset management structure with a preferred return. So, however, like I mentioned earlier, if you are going to dollar for dollar see a decrease, right? If the property produces $100,000 in cash flow, but then that 100,000 is reduced in the next month, that since the investors have no preferred return, every dollar of decrease, that $100,000 decrease will directly decrease on a prorated basis their return as well. Whereas in a promote, that is simply not going to happen. If a project is returning 10% cash flow and it's a straight 80-20 split, investors will receive 8%. in the 8% pref plus let's call it a 75-25, first investors will receive the first 8%, and then we've got that remaining 2% in our 10% scenario, and that'll be split 75-25. So 0.5% will then go to the investors, so they'll take home 8.5%. But again, if your 10% goes down to 9, investors are still going to get that 8 and then 1/4. So it's just a much more protected structure, and I highly recommend you to really dig into whatever structure you're considering investing in, and understand the ramifications of how it plays out. You should absolutely model it in a spreadsheet and stress test it and see, well, if things don't go well, how am I protected? So, and then other structures I've seen are, it's an interesting structure. I have it written here, all pref or all preferred return. And so what I've seen is the common equity, the investors in the deal receive 6% on a cash flow basis, and then 6% per year is accrued upon sale. So if you hold for 5 years, you will get 6% every year. And then since you've held for 5 years, it'd be 5 times 6 or 30%. So you'll be owed your money back plus 30% on your money upon sale, which in the end you'll receive 60% because 12%, 6 plus 6 every year. So this is a very bad structure for investors, because as you can see there, the maximum they can make is 12% in the deal. And well, many deals today, because prospective returns are so low, 12% is actually not bad, but there's no upside. And as the equity, you're taking all the risk. There's no, in this structure that I'm discussing, there's no common equity behind you providing a cushion for if cash flows were to deteriorate, or if profits upon sale aren't where they were hoped to be. You don't have common equity cushion, which you can then eat into to make that 6 and 6 whole, that 6 current, 6 accrual whole. Okay, I'm going to quickly look at the Q&A and then get back to these interesting structures. I'm clicking on Q&A and it's not opening for me, unfortunately. So, okay, somebody asked, are there any videos, articles, training sessions on underwriting where you walk through this analysis more in depth? Yes, I write many articles and I have a couple videos, and if you downloaded that underwriting model package, you should be well on your way to checking out the model, the videos. Okay, perfect. Thank you, Melissa. Can I structure a deal with pref and no promote? Interesting. Okay, so that's kind of what I touched on here, the all pref, that 6 and 6 structure. So you absolutely can, and people do. However, I'm just warning investors, this is not an ideal structure. If I'm interpreting the question correctly. Like I said, if you're receiving a preferred return where you're limited to that 6% current, 6% accrual, 12% total, there's no upside in the deal, yet you're taking all the risk because ostensibly there's no common, like I explained. So, however, if you're talking about a preferred equity deal where there's no promote, but let's say you as the sponsor are willing to put up 20% of the equity and your investors will put up 80% of the equity on a preferred return basis. And this is a senior subordinate structure where you are the subordinate equity, your investors are the senior equity, and they're receiving cash flows on a priority basis. Then, because you're putting your capital at risk first, you're saying, hey, if we're buying the property at $5 million and I'm going to put $500,000 into the deal, if we sell at $4.5 million, my $500,000 is wiped out. That provides investors a very strong confidence in the deal and in you, as long as they trust that this is really happening. I mean, even if I look at a deal skeptically, and I've seen deals where I thought, wow, this doesn't look great to me. What am I missing? And I see that the sponsor is putting in $1 million, $5 million. I think, wow, well, you know, there must be something I'm missing here. And it's a very strong anchor to a deal for the sponsor to co-invest, and even more so if they're co-investing on a subordinate basis. Like I said, in this 80-20, where the sponsor, if the price goes down, they're wiped out. If cash flows aren't there in excess of the investor's preferred return, then the sponsor will make no money on their investment. So that is a very interesting structure. And if you're very confident about a deal and you have your own money to put into it, then this preferred equity structure where you go to your investors and say, hey, put in, I don't know, 50, 60, 80% of the equity. I'll put my 20 to 50% of the equity on a subordinate basis. I'll pay you 10% or I'll pay you 12%. You'll get your tax benefits, but I'm taking the risk and I want all the upside. You will absolutely get investors excited about that structure because they like that protection. Some investors will say simply, no preferred, no structure where I'm limited to how much I can make is acceptable to me. I want to give myself the opportunity to hit a home run. So they want to be not capped to any number and just let the deal ride. So at what percent do you feel sponsor fees are excessive? So great question. So you have to look at the totality of the structure. You can't say, hey, 2% asset management fee is excessive, because it could be, but most likely it's not. Acquisition fee, same deal. So, and this is a great point. I'm glad someone asked this question. And like I'm saying, you absolutely have to look at the totality. So if you see a 2% acquisition fee, okay, that's on the higher end. You see a 1% loan guarantee fee, you're like, oh wow, okay, that's interesting. And maybe it was even a little hidden, so it wasn't, in plain sight and you had to dig for it. You're like, okay, all right. So 2% acquisition fee, 1% loan guarantee fee on the loan amount, 2% asset management fee, 1% disposition fee, or even 2% disposition fee, promote. I mean, now you're seeing all these things layered in, and you have to say, whoa, this is excessive. And something is wrong here. And what I would say, two things are wrong. So not only are investors receiving, poor net returns because they're paying a lot of fees or high promote, it's also a structure like this potentially is indicative of a sponsor's overall disposition. If you see their structure heavily weighted to fees up front, you might be looking, well, hey, this is a fee grab, and they don't really care how this deal is going to perform. They're just going to be very happy about the fees made right at the beginning of the deal. So be aware of a structure and how it may indicate what the sponsor's true motives are, or their, the way they view investors as maybe, way to make money rather than partners. So that is something to be aware of. But it's hard for me just to say at what percent do you feel sponsor fees are excessive. But that example I described is certainly excessive. And one of the, I'll skip, for the interest of time, I'll skip the other structures that are the unique structures, but I will talk about that alignment of interest I mentioned. So at the end of the day, so structure will define alignment of interest very well. Investor can say, or a sponsor can say, well, I really care about investors, and this is a good deal. I'm going to work very hard. I care about my reputation. The structure will really determine the alignment of interest. So like I mentioned before, the Irr hurdle, if you're investing in an Irr hurdle, you have to believe that the sponsor is biased towards a sale sooner rather than later. So you have to be aware of these incentives and make sure that your investment strategy is aligned. If you're more of a hold for long term, you might want to invest where there is a promoted cash flow or even no pref, and that way the sponsor is very content just holding and also participating in the cash flow. And then, like I mentioned as well, the biggest alignment of interest is co-invest. So how much are they investing? Whose pocket is it coming out of? Is it them? Is it their family and friends? Will you ever know the real answer? No. But you can at least ask. But that is the biggest alignment of interest indicator, and really as an investor should be one of the most important things you focus on. So with that, I want to wrap up. I unfortunately have to leave a little bit early before the scheduled 10:45 ending time, but I want to open it up for Q&A. So please, you've been doing a great job asking questions all throughout. So please just keep it going, and we'll end right at that 10:30 mark.
Thanks, Rob. Yeah, while we wait for some extra questions, hopefully, does anybody else have questions for Rob while he's still on? We had one in the Q&A.
Yeah, I'm having a hard time opening it, so it's
yeah, I can share with you here.
oh, what is crystallization? All right, pulling all the secrets out. Crystallization is very complicated, and it's I'll try to do the very quick. So crystallization is perfect for investors that don't want to see a sponsor sell. Let's say, for example, the value of the property is increased and the sponsor they're sitting on a promote. If they could sell, they'll make $1 million promote, and they're very excited. They want to sell. They want to make that promote. Well, instead, you can crystallize the investment, and basically what that means is you'll mutually agree, LPs and GPs mutually agree upon a hypothetical sale price, run that sale through the waterfall, and see what that promote actually will be. And if, let's say, it is that $1 million, and then what can happen is the sponsor's capital account in the deal, let's say the sponsor invested 10%, which was $1 million. Well, by crystallizing the promote, that $1 million of promote that they would get from a sale will just go to shift their capital account to now be 20% of the deal, right? They invested $1 million at 10%, and now it's another $1 million. So they own 20% of the deal, and the crystallization freezes the promote, freezes the pref, and now GP and LP are pari passu moving forward and receiving economics of the deal on a prorated basis based on their new capital accounts. So I only want to do that. Do you have any guidelines on coming up with the discount rate for NPV calculation? Yes. So this is a personal calculation. So what do you have the opportunity to invest in, at what rate, and how much do you personally value money today versus tomorrow? If you, it just really depends. So again, if you have the opportunity to invest in lucrative deals that have high returns, and that's your opinion, that's your stance, then you'll hold yourself to a higher discount rate standard. So I use personally a 20% discount rate because I feel confident in my ability to achieve high returns with my own personal money, because I'm co-investing in my own deals, as well as, I'm a young guy and I want money today, and if I have to wait for it tomorrow, it better be discounted because money today is very valuable to me. So it's just how you view it, and that's really how you have to approach it. What amount of co-investing do you typically look for? So this varies drastically. So in a traditional JV equity structure, the GP will invest 10%, or at least they'll tell you they'll invest 10%, and then they'll go raise that from family friends. So the only right answer that you can possibly say here for what is the right co-invest is who and how much as a percentage of their wallet. So if all they have in the bank is $10,000, and they're willing to reinvest a significant portion of their acquisition fee, that might be good enough. If they're a well-established sponsor and they have, a very large portfolio and maybe a few $1 million in liquid assets or liquidity in bank statements, you would much prefer them to invest a more meaningful portion of that. I would say maybe even $500,000 in that sense there. Can we get a copy of the links listed here? I didn't, links listed. I only linked to the Lone Star Cap Group website. I'll also put my email here if you want to reach out to me directly and ask me for this exact model, because the model I have in the underwriting model package is just a blank one, and this one has the example numbers in here, which are nothing fancy, and then I also have just this quick little topic sheet. So feel free to email me. What are you doing, if anything, to adjust your fees and waterfalls as well as leverage terms at this point in market cycle? That's a great question. So I would say that fees and structure have less to do with the market cycle and more to do with investor demand, which is correlated to market cycle. So there is a correlation, but I'd say it's driven by investor demand. So if investors are demanding of, all right, let me just type this in here. If investors are very demanding of the type of investment you are sponsoring, then you will have the opportunity to command better terms. However, if there's a lot of people just like you, and you may not have some sort of competitive advantage, or you are seen mostly as a market operator, you will just be, your fees and structure will largely be based on investor sentiment, and that has to do again with reputation, track record, and things like that. So in terms of this cycle, I would say, as this may not sound so great to investors, there may be a good reason to lower your preferred return hurdles in today's market, because achieving 8% return, especially on a current yield basis, like I mentioned before, is very challenging. And it is not unreasonable for a sponsor to say, hey, can we just do a 6 or a 7% preferred return so that we can make money here? And it depends on the risk of the deal. So you want to have that match as well. Can I roll my acquisition fee into the deal? Yes, absolutely. And when doing so, you should absolutely consult an accountant, because things can be very interesting and structured in ways that can be more or less beneficial to you as the sponsor rolling your fee in the deal. Okay, so I think the questions are sort of dying out and I have to take off. I'll maybe stick around for 1 or 2 more. If no more come in, I very appreciated the opportunity to chat with you guys, and hopefully it was as interactive as you want and that I didn't just kind of zone out and just, talk away. But again, feel free to reach out to me. Yeah, thank you very much.
Thanks, Rob. Yeah, so Rob put his email in the chat box if anybody wants to get in touch afterwards. Make sure you jot that down, keep up with that. Thanks, Rob. That was great, very informative, and we appreciate you speaking.
All right, thank you so much. Have a great day.
Thanks.